A man in his late 60s is sitting at his kitchen table, looking at two accounts side by side. One is his investment portfolio, worth far more today than what he originally put into it. The other is a letter from his bank, offering him a line of credit against that very portfolio. He's confused. He doesn't need to sell anything to get cash in his hand. He doesn't even need a job. He just borrows. And somehow, according to his accountant, he may never have to pay income tax on any of it. That confusion is the exact moment this video is about, because what this man stumbled into is a real legal strategy that wealthy families have used for decades, one that's completely legal, widely used by financial professionals, and yet still surprises most everyday retirees the first time they hear about it. It's often called buy, borrow, die. And by the end of this video, you'll understand exactly how it works, why it's legal, who it actually helps, and, just as important, where the risks are that nobody talks about. Why this matters. Here's why this deserves your attention, even if you don't think of yourself as wealthy. Most people spend their whole working life hearing the same advice. Save into a retirement account, let it grow, and when you need the money, withdraw it and pay taxes on what you take out. That's the standard path, and for most people it's still the right one. But there's a separate path that plays by different rules. It applies to people who hold appreciated assets, things like stocks, real estate, or a business outside of a retirement account. If you're in that situation, or you're planning your estate and want to understand how wealthier families reduce their tax bills, this strategy is probably already shaping decisions being made around you, even if no one has explained it to you directly. Ignore it, and you might sell assets in ways that trigger more tax than necessary. Understand it, and you gain a much clearer picture of how income, borrowing, and inheritance actually interact under US tax law. What you'll learn. In the next few minutes, we're going to walk through three things. First, what the buy, borrow, die strategy actually is, in plain English. Second, why it works, the specific tax mechanics that make it possible, explained without jargon. Third, the real risks and limitations that make this strategy unsuitable for a lot of people, even though it sounds appealing. Let's start with the basics. The core idea, explained simply. The strategy has 3 steps, and the name gives them away. Buy. You purchase an asset that's expected to grow in value over time. Stocks, a rental property, shares in a business. Nothing unusual here. This is just ordinary investing. Borrow. Instead of selling that asset when you need cash, you borrow against it. Banks and brokerages routinely lend against the value of stock portfolios, real estate, and other collateral. The loan gives you spendable cash, but because a loan is an income, it isn't taxed the way a paycheck or a stock sale would be. Die. This is the part that surprises people. Under current tax law, when someone passes away, the assets they leave behind generally receive what's called a step-up in basis. In plain terms, the asset's value is reset to its worth on the date of death for tax purposes. If heirs then sell the asset, they may owe little or no capital gains tax on the appreciation that happened during the original owner's lifetime, because, for tax purposes, that appreciation effectively disappears. The estate can also settle any outstanding loan using the assets themselves, without the original owner ever having sold anything or reported a taxable gain. Put those 3 pieces together, and you get a strategy where someone can spend money that came from a loan, never sell the appreciated asset that grew that money, and pass the asset to heirs who may owe less tax than if the original owner had simply sold and reinvested along the way. That's the whole idea. Nothing hidden, nothing exotic, just a sequence of legal financial moves that happens to interact very favorably with the tax code. Why it legally works. Now let's slow down and look at why the tax code allows this, because understanding the why is what separates a real strategy from something that sounds too good to be true. The first piece is simple. Loans are not income. If a bank hands you $100,000, that money isn't taxed because you owe it back. This is true whether you're borrowing to buy a car, a house, or simply to have cash on hand. The IRS taxes income, money you earn or receive that you don't have to repay. A loan doesn't meet that definition, so there's no tax event when you take one out. The second piece is unrealized gains. As long as you hold an asset and don't sell it, any increase in its value is quote-unquote unrealized. The tax code generally only taxes gains when they're quote-unquote realized, meaning when you actually sell. So an investment portfolio can double or triple in value, and as long as you never sell, you owe nothing on that growth. This is different from income you receive in cash. It's growth that exists only on paper until you cash it in. The third piece, and the one people find most surprising, is the step up in basis at death. This rule has existed in the tax code for a long time, and its original purpose was largely administrative. It can be difficult for an estate to reconstruct decades of purchase records for inherited property. Whatever the original reasoning, the practical effect today is that appreciation that built up during someone's lifetime is generally not subject to capital gains tax when it passes to heirs. It's one of the more debated features of the current tax code, and it's been the subject of various reform proposals over the years, so it's worth remembering that the specific rules can change with legislation. When you combine these three pieces, untaxed loans, untaxed unrealized gains, and the step up in basis, you get a legal pathway where wealth can be spent, grown, and transferred with much less income tax exposure than the traditional path of earning, saving, and eventually withdrawing. A practical example. Let's make this concrete with a simple, realistic example. Suppose someone owns stock that has grown significantly in value since they bought it. Instead of selling shares to fund retirement spending, which would trigger capital gains tax on the growth, they open a securities-backed line of credit through their brokerage and borrow against the stock instead. They use that borrowed money to cover living expenses. The stock keeps growing in the market, uninterrupted, because none of it was sold. Meanwhile, the loan sits there, accruing interest, which the borrower will eventually need to address, either by paying it down, refinancing it, or having it settled from the estate later. When that person eventually passes away, their heirs inherit the stock at its current market value for tax purposes, and any outstanding loan can typically be paid off using estate assets. Depending on how everything is structured, this can meaningfully reduce the total capital gains tax that would otherwise have been paid over the years. That's the mechanism in action. Notice what didn't happen. No stock was sold during the person's lifetime, no capital gains tax was triggered along the way, and the loan itself was never treated as income. Common misunderstandings. There's another part many people overlook, which is that this strategy is often described as if it were a secret loophole. It isn't. Every piece of it, securities-based lending, the treatment of loans as non-income, and the step-up in basis, is publicly documented in tax law and used openly by estate planners, wealth managers, and accountants. The word secret makes for a good headline, but the real story is that this is a well-known planning technique that simply isn't well explained to the average person. Another misunderstanding is thinking this only benefits billionaires. It's true that this strategy shows up most often in stories about extremely wealthy individuals, partly because they have the largest asset bases and access to the most favorable lending terms. But the underlying mechanics can apply, in smaller form, to anyone who holds appreciated investments outside a retirement account and has access to a securities-backed loan. That brings us to something equally important. This strategy is not free money, and it's not risk-free. Loans still have to be repaid or serviced, usually with interest. If the value of the underlying asset drops significantly, a lender can issue what's called a margin call, requiring the borrower to add cash or sell assets to cover the shortfall, which can force exactly the taxable sale the strategy was designed to avoid. Interest rates also matter enormously. When borrowing costs are high, the math behind this strategy becomes far less attractive because the interest expense can outweigh the tax savings. There's one more important exception worth knowing. Not every asset qualifies for favorable lending terms, and not every estate situation benefits equally from the step-up in basis, especially depending on how assets are titled or held. Estate size, state law, and the specific type of asset all affect how well this strategy actually performs in the real world. What you should do. So what does this mean for you, practically speaking? If you're someone with meaningful investments outside of a retirement account, and you're thinking about how to fund retirement spending without triggering large tax bills, this is a concept worth discussing with a qualified tax professional or financial advisor. They can look at your specific holdings, your loan-to-value comfort level, and your estate planning goals and tell you whether a securities-backed loan makes sense for your situation. If you're in the process of estate planning, it's worth asking your advisor how step-up in basis applies to your specific assets, since the answer can vary based on how property is owned and titled, and since tax law in this area has been a frequent target of proposed legislative changes. And if none of this applies to you directly, it's still useful to understand because it explains a pattern you'll see referenced again and again in financial news: why some very wealthy individuals appear to have very low reported taxable income despite living comfortably and growing their net worth. Dotlet quotes bring this together. The buy, borrow, die strategy isn't a trick or a hidden IRS secret. It's a legal sequence. Buy appreciating assets, borrow against them instead of selling, and let the step up in basis reduce the tax burden when those assets pass to heirs. It works because of three long-standing features of the tax code. Loans aren't taxed as income, unrealized gains aren't taxed until you sell, and inherited assets generally get a reset in tax basis at death. It carries real risks, including interest costs, margin calls, and the fact that tax rules in this area can change. It's not something to attempt without professional guidance, and it's not a fit for everyone. Understanding strategies like this isn't about chasing a shortcut. It's about knowing how the financial system actually works, so you can make informed decisions about your own money. Whether that means talking to a tax professional, reviewing how your assets are structured, or simply understanding the news the next time this topic comes up. As always, tax law changes, and your own situation is unique, so it's worth verifying anything discussed here against current guidance from the IRS or a licensed professional before making decisions. If you found this video helpful, give it a like, subscribe for more videos like this one, and share it with someone who could use a clearer explanation of how these strategies actually work.